You know, when you're trying to save for something really far off, like retirement, it always feels a bit uncertain. And remember back around 2014, 2015 in Europe, things got really weird with interest rates. Long-term rates just kept dropping and dropping almost to zero. It made you wonder, right? Were big investors just like desperately throwing money anywhere for any return? Was it just a search for yield?
Yeah, that search for yield idea was definitely the story going around. And it kind of makes sense on the surface. Rates are super low, so people maybe take more risks. But this deep dive we're doing, it's based on some really interesting research from the Bank for International Settlements. And it suggests that, well, yes, maybe some yield searching was happening, but there was this other, much bigger, and actually quite surprising force driving things for some key players.
Okay, surprising. I like surprises. So we're looking at a BIS paper. What's the title again? The Hunt for Duration, Not Waving, but Drowning. That's quite a title. So our mission here is to figure out what was really pushing those long rates down so low by looking at what these specific investors were like forced to do.
Exactly. We want to peel back the layers, go beyond that simple search for yield narrative, and see the hidden machinery at work.
Right. So who are these investors working behind the scenes? Who are we talking about?
We're talking about the real heavyweights in long-term money, insurance companies, and pension funds. I mean, these guys managed trillions of euros. Think about that. All the money set aside for pensions, for life insurance payouts that won't happen for decades.
Huge amounts of money. Money that absolutely has to be there 20, 30, maybe even 40 years down the line.
Precisely. And that's their core challenge, right? They've made these rock-solid promises, those are their liabilities, to pay out money way off in the future. So they have to invest the premiums and contributions they get today so that the money grows enough to meet those promises when they come due.
Makes sense. Can't just stuff it under the mattress. It needs to, well, work for them over decades.
Exactly. And a really key idea here is something called duration. Now, let's not get bogged down in the math. Just think of duration as basically how sensitive something financial like a bond or even one of those future promises is to changes in interest rates. Or maybe an easier way. It's sort of like how long-term or short-term something acts financially when rates wiggle around.
Okay, duration. Sensitivity to rate changes. Got it. Can we make that simpler? Like an analogy?
Sure. Let's say you've got two debts, a car loan, maybe 3 years left, and a big 30-year mortgage. Now imagine interest rates across the economy shift up by 1%. Your car loan payment probably doesn't change much, right? Its value isn't super sensitive to that rate change right now, short duration. But the 30-year mortgage, whoa, the value of all those future payments is really sensitive to that 1% change. It reacts much more strongly. The mortgage has a much higher or longer duration. It's like a longer lever being moved by interest rates.
Okay. So longer time scale, more sensitive. Higher duration means bigger value swings when rates move. Okay, I think I get that.
Exactly. And for these big insurers and pension funds, their main job, their goal, is to try and match the duration of their assets, the stuff they own, like bonds, to the duration of their liabilities, those promises they've made. Why? Because if interest rates go up or down, they want the value of their investments to move roughly in sync with the value of their future obligations. It's how they manage that huge interest rate risk over such long periods.
Okay, so they're trying to balance things out. Keep the sensitivity of what they own aligned with the sensitivity of what they owe. Keep the levers the same length, sort of. So what happens when long-term rates start to fall, like they did so dramatically in Europe back then?
Right, this is where the headache begins. When those long-term interest rates go down, the value today, the present value of those future promises, their liabilities, actually goes up.
Wait, hang on. Rates fall and the future promises are worth more today. That feels backwards.
It does feel counterintuitive, I know. But think of it like this. If the interest rate you expect to earn is lower, you actually need more money set aside today to be sure you'll hit a specific target amount years from now. A lower discount rate makes those distant future payments loom larger in today's terms.
Okay. Lower expected return means you need a bigger starting pot.
Right, I'm with you. Lower rates make future promises look bigger, heavier today.
You got it. And here's the real kicker. Often, the duration of their liabilities, those super long-term promises, is inherently longer than the duration of the assets they typically hold. So, when rates fall, the value of those long-duration liabilities doesn't just go up. It goes up faster and more than the value of their shorter duration assets.
Oh.
Yeah. This creates what's called a duration gap, or it makes an existing gap even wider. Suddenly, their asset lever isn't long enough to match their liability lever, and the mismatch is growing.
So the Risk Balancing Act gets thrown off. And wasn't there something in the paper, negative convexity?
Yeah.
That sounds complicated. Does it make this gap worse?
Yeah.
It does, yeah. Let's skip the deep math. Just know that negative convexity is kind of a technical property of these liabilities. It basically means that as interest rates fall lower and lower, the duration of the liabilities doesn't just increase steadily, it actually stretches out even faster. It accelerates. So the lower rates go, the faster the duration gap widens. The problem gets bigger, quicker. It's like it starts to snowball.
Okay, wow. So falling rates create this accelerating problem, a widening duration gap. Their risk is getting out of control. What can they possibly do about that?
Well, to plug that gap, to get their risk back under control, they need to make their assets behave more like their liabilities. They need to increase the duration of their assets. And the most straightforward way to do that, buy assets with longer durations, primarily long-dated bonds that pay out way, way in the future. Those have the high duration they need.
Right, buy long bonds, increased asset duration. Seems logical, but
Hang on. You said rates were falling. Doesn't that mean the price of those long bonds was going up? Maybe way up. Absolutely. Bond prices and yields move in opposite directions. As yields plunge towards zero, the prices of those long-term bonds shot up. And this right here is the core kind of mind-bending finding of this research. Normally, basic economics 101, right? Price goes up, what happens to demand?
demand goes down, people buy less when things get expensive. Simple.
Exactly. But for these specific institutions, the insurers, the pension funds, because they had to fix that duration gap, because their primary mission is meeting those long-term promises, they were essentially forced to buy more of these long-dated bonds, even as the prices were skyrocketing and the yields, the returns, were becoming tiny.
Whoa, wait, let me get this straight.
Yeah.
They bought more of something precisely because it was getting more expensive and offered a terrible return. That sounds completely backwards, like upside down demand.
It feels totally upside down compared to how we usually think about markets. Let's try another analogy. Imagine you're a contractor building a very specific bridge structure. That's your liability, your promise. Suddenly, the building code changes due to, let's say, unexpected interest rate weather. Now, the code demands you use much, much longer support beams than originally planned. Super long ones. Those are your long-duration bonds. Not only do you need more of these specific long beams, but because the code changed for everyone, these beams are now incredibly rare and expensive. The price has gone through the roof. But you have to finish the bridge. It's your job, your contract. So what do? You grit your teeth and buy more of those ridiculously priced long beams, maybe even more than you first thought because the code change is so drastic. Your demand for that specific expensive item went up, driven entirely by the requirement of the job building the bridge to the new code, matching your liability duration.
Wow, okay, that clicks. So it wasn't, ooh, low yields look great, let's buy. It was, oh crap, our liabilities just got way longer. We have to buy these expensive long bonds to stay safe. It wasn't a voluntary search for yield. It was a mandatory hunt for duration.
You nailed it. That's
Yeah.
exactly the term the paper uses. And they call this phenomenon upward sloping demand, or sometimes perverse demand, higher prices leading to more demand. But, and this is crucial, it's only for these investors buying these specific long assets under these specific low-rate conditions. It's not a general market rule.
That totally changes the narrative. And did the research actually find hard evidence that this was happening, like in the data?
They did. They dug into detailed data specifically from the German insurance sector. Germany has a massive insurance industry, a huge player in European bond markets.
Okay, so what did the German data show?
Well, it showed that in 2014, right when those long-term rates took a nosedive, German insurers massively increased their buying of government bonds, particularly the long-dated ones. Their total holdings of government bonds jumped by, I think it was 16% in value that year. Normally, it was more like 6 or 7% growth. So a big jump in buying.
They were definitely buying more of those expensive bridge beams then.
Exactly. And the data showed they were specifically targeting duration. Their overall asset duration, that's a sensitivity measure, it jumped significantly from around 11 years up to nearly 16 years just in 2014. At the same time, the estimated duration of their liabilities also shot up from about 20 years to over 25 years. They were basically running hard just to try and keep the gap from widening even further.
Wow. So they were actively lengthening their assets to try and keep up with their lengthening liabilities. Were they a big enough force to actually move the market?
Oh, absolutely huge. The study calculated that in 2014, these German insurers were responsible for something like 40%, 40,
Uh-huh.
of all the net purchases of bonds by German residents.
40%. But how much of the total bonds did they even hold?
That's the striking part. They only held about maybe 12 or 13% of the total bonds outstanding, but they accounted for 40% of the new buying that year. They weren't just participants. They were a massive driving force.
Okay, 40% of the net buying. That's
Yeah.
definitely driving the bus, not just riding along.
For sure. And the really clever part was this statistical analysis. It found evidence consistent with this perverse demand, but specifically for the really long duration bonds. Bonds with duration above a certain point, they estimated around 13 or 14 years. For those bonds, the insurer's demand actually went up when the price went up. The statistics backed up the theory.
And you're sure this wasn't just, everyone doing the same thing? Banks, households?
No, that's a key distinction they made. This effect was strongest for safe government bonds, the kind insurers need for matching. And it wasn't seen nearly as much, or at all, in other investors like banks or just regular people buying bonds. It really isolated this behavior to these specific institutions driven by their specific duration needs. It wasn't just a market-wide panic or yield chase.
Okay, so it wasn't reckless speculation. It was actually a very specific, very technical risk management reaction that just happened to look really strange and counterintuitive from the outside.
Precisely. And this is where we get to why this matters to, you listening. Why should you care about insurer duration gaps? Because this hunt for duration, when done by such enormous institutions all at the same time, doesn't just happen in a vacuum. It acts like a massive amplifier.
An amplifier, how does that work? Like a feedback loop?
It's exactly like a feedback loop. Think about it. Some initial factor pushes long-term rates down a bit. This drop widens the duration gap for insurers and pension funds, and remember that negative convexity makes it widen faster as rates fall. So they are forced to buy more long bonds to manage this growing risk. This huge wave of forced buying pushes the price of long bonds up even more, which drives their yields down even further, which of course widens the duration gap again, maybe even more, leading to potentially even more forced buying.
Wow. It feeds on itself. The falling rates cause buying, which causes rates to fall further, which causes more buying.
It becomes this powerful self-reinforcing cycle. And it helps explain why those long-term rates might have fallen so far, so incredibly fast back then. It wasn't just one thing. It was this dynamic amplifying the move.
And those are the rates that ripple out everywhere, right? Affecting mortgage costs, how much governments pay to borrow, what companies pay, even the long-term returns on our own savings or pension pots. So what these giant kind of invisible institutions do to manage their own complex books directly shapes the financial environment we all live in.
Absolutely. And that brings us right back to that evocative title, not waving, but drowning. From a distance, maybe all this bond buying looked like confident investors waving enthusiastically, chasing returns. But the research strongly suggests a big part of it was these institutions effectively drowning in that duration gap caused by the falling rates. They were desperately buying duration, almost regardless of price, just to keep their heads above water from a risk perspective.
That's a powerful image, looking like confident swimmers, but actually just trying not to sink because the current's changed.
And there's one final, maybe slightly uncomfortable thought the paper kind of leaves hanging there. While this behavior hunting for duration was perfectly rational and prudent risk management for each individual insurer or pension fund, the collective impact of everyone being forced into the same trade, buying the same specific long-dated safe assets, might have paradoxically made the entire market more fragile. It could have increased the potential for a really sharp, painful snapback, a sudden jump up in long-term yields, if market conditions were to suddenly reverse.
So everyone acting individually safe could, together, create a new kind of systemic risk. That's a classic unintended consequence in finance, isn't it?
It really highlights how these technical behind-the-scenes rules and behaviors of huge players can have these massive, sometimes unexpected ripple effects.
Okay, let's wrap this deep dive. So the big takeaway here is that the crazy low long-term interest rates we saw in Europe weren't just about investors desperately searching for yield. A huge part of the story, according to this research, was driven by giant insurers and pension funds being forced by their own risk management needs, specifically managing this duration gap that exploded when rates fell to buy enormous amounts of long-term bonds, even as prices soared. This created this weird upward sloping demand that acted like an amplifier, pushing rates down even further and faster.
Exactly. It wasn't necessarily greed. It was largely driven by the complex mechanics of managing long-term promises in a world of falling interest rates, a structural necessity for them.
Which really leaves you with something to think about, doesn't it? Next time you see something really odd happening in financial markets, like rates going to places that seem illogical, maybe ask yourself, could this be driven by the hidden rules and unavoidable actions of giant institutions managing risks we don't usually see? And could the very actions they take to stay safe individually, maybe, just maybe, be building up a different kind of pressure or fragility in the system as a whole? It certainly makes you think about the unseen connections shaping our financial world.